Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Welcome back. Hope you're enjoying your summer, getting outside, and unplugging from boring old stuff like this. But it's not all that boring. If you're on a plane, on a walk, or whatever you're on, I think you'll enjoy this one. We've got James Maund from KraneShares, a leader in the ETF space, bringing his experience at Goldman, the New York Stock Exchange, and now KraneShares to the table as we explore their main investment pillars: China-focused tech, carbon emissions, and of course, alts. James shares his insider's perspective on the rapidly evolving ETF landscape, whether options overlay strategies are eating the world, and the challenges and opportunities facing both established players and new entrants in the ETF space. Send it. This episode is brought to you by RCM's outsourced trading desk, where ETFs like KraneShares come to trade unique global futures markets, like carbon futures. How do those work? Right there on RCM's 24/6 outsourced desk. Check it out at rcmalts.com/24. rcmalts.com/24. Now back to the show. All right, we're here with James from KraneShares. James, how are you?
Doing great. Thanks for having me, Jeff.
No worries. What's new in New York City these days?
Well, it's pretty quiet here mid-August.
Yeah, you're the only one there in the summer.
We've a handful of people, but it's definitely noticeable that it's August, given the lack of crowds out there. But it's been
We
good.
were talking a bit offline. You go to your escapes Vermont.
That's right. Yeah. Spend a lot of time in southern Vermont, most winter weekends. We've been spending some time there summer weekends as well. It's been
What's
really nice this year.
what's your ski hill there? I went to school at Union College. So we used to jump over to
Sure.
Vermont to ski all the time.
Yeah. So we're on Stratton Mountain, and
Nice.
yeah, it's great.
I think that would maybe my favorite. Killington upset me 2 years ago. We were there in the summer and you buy the whole pass and half the stuff was closed. I'm like, hey, we're just driving through here. I want my money back. Like, sorry. Clearly says.
Tough.
Yeah.
Yeah, it's a tough business, it's weather dependent, and it's hard to keep things going year round, but they do what they can.
I hear you. So let's talk a little bit about your background before we get into KraneShares.
Sure.
So
Yeah.
you're born and raised East Coast?
East Coast, grew up in New Jersey, Montclair, New Jersey. And have been in this area my whole life in the New York area. So I went to school at Wesleyan up in Middletown, Connecticut, and week after graduation, moved down to New York City, and been here kind of ever since. So it's been a good run. Early in my career, I started at Goldman Sachs in the derivatives middle office. Yeah. Learned all about kind of the equity derivative products and the operational aspects, kind of nuts and bolts, all the way from trade through settlement and beyond. And from there, took a job with the ETF specialist group on the floor of the New York Stock Exchange. So that was a legacy piece. Goldman bought a business from Spear Leeds and Kellogg that had a big floor trading operation and an electronic trading operation. So it's kind of legacy Spear Group, making markets on ETFs. At that point, there were about 300 ETFs listed. This was kind of early 2000s.
And this is before or after the flash crash? Wasn't Spear Leeds involved in that a little bit?
This was, yeah. Well, unfortunately, it was flash crash involved all the market makers at the time. Spear had a big group, and a lot of others did. So yeah, the flash crash was May of 2010. So this was years before that. I'm talking 2004, 5, 6. So I spent a handful of years on the floor of the New York Stock Exchange, and then about a year and a half on the floor of the American Stock Exchange, which was still separate from the NYSE at the time. And just as an ETF specialist in a variety of products, international ETFs, it's US listed funds with international underliers, and then worked with some of the sector, select sector and S&P 500 funds toward the end of my time there.
Was the feeling even back then, so this is early 2000s, was the feeling like ETFs, this is going to be huge, or was it like, oh, these are some new things, let's try it out?
No, it was, I think there was definitely a feeling that it was going to be big. There was still, the market was still dominated by mutual funds at that point, and ETFs were pretty much focused on equities. All the assets were in domestic equity ETFs. Uh, International ETFs had a little bit more of, they were just kind of coming onto the scene and a little bit more interest. And then fixed income ETFs were just getting started. Very early days for fixed income. So I think people were just starting to get a glimpse of how ETFs could be a wrapper for a lot of different underlying asset classes, and just starting to get a glimpse of the growth potential. But certainly, SPY, the Qs, the select sectors were all very successful at that point, and people were just starting to get the wheels turning on how big this could be.
And then I ask all the Goldman alums we have on, did it feel right? I can't remember who Matt Taibbi or something was that. I can't remember where he wrote from, but he called it the vampire squid around the GFC and everything. So having been on the inside and knowing people there, is it a vampire squid or is it just a normal firm trying to make some money?
I think it's more the latter. There's certainly a lot of very smart people there, but I think there's from my seat, from my perspective, making markets and ETFs on the floor, and all the interactions I had when I was there, it was just a lot of smart, hardworking people trying to do the best they could, moving the needle for the business.
And for all our young listeners, how hard is it to get that seat?
Uh, well, at this point, it's impossible because there's no more floor-based trading.
Yeah.
I would say it's the best job I'll ever have. It was a really, really cool environment to go to the exchange every day and put
Yeah, I
on your
was
trading
at
packet.
Board of Trade, so ditto
Yeah,
that. Can't do that anymore either.
yeah. But no, it's certainly gotten, say, a lot more competitive. I think there were a lot of folks back then, particularly on the floor, who worked their way up. It was more like, uh, kind of an apprenticeship sort of situation where no matter what you did in school or kind of what other experience you had, it was very unique working on the floor, being able to think on your feet and do a lot of those things, kind of human to human, that are now technology driven.
I, it's interesting to hear you say that because I'm always saying, oh, New York versus Chicago. The Chicago pits were truly that, like, you could just be an athlete who didn't go to high school and they'd be like, all right, you're big and you can scream. We'll teach you how to trade.
Yeah, I think
Versus New
that
York, I always argue like, well, you had to still go to a good school and know some people to get in somewhere.
Yeah, that's fair to say. I think that the pit-based trading, I had a good friend who worked in crude futures on the NYMEX for a couple of years, and again, you know, physical presence and it was that was a much more kind of physical environment. The New York, is a little more, a little less kind of throwing elbows and a little more, thinking on your feet. But
Exactly. And then I've
um,
also thought that New York smartly kind of co-opted Chicago futures markets by wrapping them into mutual funds and ETFs and all that, which we can get into later. But,
sure,
20
yeah,
years ago, you had to open an account at a futures brokerage to get the type of access now you can just get with an ETF.
yeah,
So
yeah.
half of me is bitter at that, being a futures guy, but half of me is, hey, that's the way the world works. That's progress.
That's right.
So let's get into KraneShares. You guys do a lot, so help us kind of give us a broad, you got some different buckets you guys are operating in. Give me the broad elevator pitch and then we'll go from there.
Sure, absolutely. KraneShares, we're just 11 years old now. Our flagship product is a KWEB, which is a China Tech ETF, and that's really where we got our start. Our founder, John Crane, is a serial entrepreneur, spent many years in China, uh, building businesses, sold several businesses there, came back to the US and was talking about all the growth he saw there and all the opportunity, and realized when he was talking to friends and family about this experience that it was actually really hard to access investing in China. And he decided to start this asset manager, KraneShares, to provide that access. And that was really the genesis of the firm. And we're still heavily focused on China and China thematic. Funds are a big piece of what we do. They're our first pillar and our largest pillar. And we provide not just the access through those products, but a lot of resources around investing in China. We have a daily note, China Last Night, that our Chief Investment Officer, Brendan Hearn, writes, has a large following. And we really try to be more of a resource for our clients and help with providing information that, again, it's traditionally a harder to access market, and information on the market, kind of unvarnished, kind of unbiased information, or maybe biased differently from what you'd get in the Western media, is a little bit hard to come by. So we really try to focus on putting that information in the hands of our clients and our investors. We also have two other pillars.
I'll dig into China first. So,
okay, sure. Yep.
Talk to me a little about the interest from back when that KWEB started, or China Tech was hot, versus today, versus in the middle. Has it waxed and waned and gone cyclical, or has it been a straight line up?
Yeah, no, certainly far from a straight line. It's a pretty volatile space to be in. And you have a country that's growing rapidly. You have a technology environment, whether you're trading China Tech, US Tech, any area, that market is going to be growing quickly and changing a lot. So it's very dynamic. And that fund's grown quite a bit. I joined KraneShares January of 2020. Our AUM was about $3 billion. And then just about 2 years later, it topped out around $17 billion. KWEB itself, it's grown substantially in that time. Obviously, if you look back at the price history of some of the China Tech names, KWEB peaked in February of 2021, about $110 a share. And in all of my time on Wall Street working with ETFs, it's really the only ETF that I've seen, as the price came down, we actually saw net creates. So shares outstanding more than quadrupled, almost quintupled, from about 40 million out to about 200 million out in that time that the share price came down for a variety of reasons, from its peak in February of 2021 to the low in October, a little over, about a year and a half ago now.
Who was the big holding that rode it up to those all-time highs?
Oh,
Tencent or one of those?
Yeah, exactly. Tencent, Alibaba, Pinduoduo, all of the big, big China tech names. They're the largest holdings in the fund. And, I think for a variety of reasons, this was into the COVID, bust boom, however you want to think about that. And then the ensuing kind of, back and forth between, growth in the U.S. and the political rhetoric there, growth in China, and, a lot of different opinions and a lot of different actions to try to, kind of figure out the best path forward for those companies. And I think we're at a point now where we've been in a consolidation phase for quite a while, and it looks as though the share price has bottomed. So hopefully we'll see a nice recovery in the coming months and years.
And I've heard, may have been on my pod this last week, but someone was saying, oh, stocks don't always go up. Look, at China's been a growing economy where the stock market's been flat for X years. I don't have the data to support that. So if you agree with that or not agree with that, and then contrast that with the tech piece of China, is that the same story or a much different story?
No, I think it's certainly, you have these strong demographic factors. You have, a growing middle class. You have this rising tide in China that still exists, still growing. You've seen, U.S. markets and U.S. tech expand very quickly and reach very high multiples, versus China Tech, which has been much more muted growth over the last few years. So if you look at the difference in valuation between China Tech and U.S. Tech, there's a big gap right now. And, obviously there are a number of different opinions about, why that is and kind of where the valuations are between U.S. Tech and China Tech.
Like PEs and everything, or just pure valuations?
Yeah, no, pure valuations, PEs. There's obviously a number of different ways to look at it, but I think you've just seen this huge run in U.S. tech that in the past couple of weeks here, we've seen maybe some cracks, maybe some downturns. Again, a variety of opinions about whether this was a short-term pullback in the context of a continuing bull market or something else. But there's certainly big kind of gap for China Tech to make up in that regard. So it's pretty compelling from that perspective.
And then I'm sure you get this from potential investors, or maybe not, that's of interest, but right, how do you answer that? Oh, it's government manipulated, whatever, name 5 complaints about China. Like what, I guess, what are some of those complaints and what are your answers to those complaints?
Well, again, I mean, the government plays a big role no matter where you are. Certainly, China's a centrally planned economy, and there's a lot of influence there, a lot of direct influence as well as indirect influence. U.S. regulations are impactful on U.S. tech. European regulations are impactful on Europe. And now so many of these companies are, have such a global footprint. If you look at a lot of what are thought of as, the larger U.S. companies like Apple and Tesla, and you look at the amount of earnings that they derive from China, it's really global. So it's really hard to say, oh, one government is maybe having an impact on companies in that country that don't exist for other companies or other countries. So I think there's certainly a different approach in terms of how regulators in different parts of the world think about the companies that do business there. But there's certainly we're not in a scenario where there's one country or one region that has a lot less regulation. I think it's just a matter of, as one economy, one market continues to evolve and grow very rapidly, and you have some other economies and markets that are a little bit more established, you're naturally going to see more volatility in the growing economy.
It surprises me they don't just basically pump up the stock market and have all these flows into all these ETFs, everything tracking the index, and be like, it seems like an easier way to make money for them, but perhaps it's gotten too big for them to control in that way.
There's a bit of that. I mean, there's certainly this concept of home team buying that you see from different analysts, and that's real. I mean, the local kind of top names in the indexes and a lot of the local ETFs are being bought by the home team. That there is significant government investment there. And that's all part of it. Certainly, it's been supportive. And if you look again at the economic growth trajectory and valuations, it looks like a really strong long-term investment. And again, we've seen a lot of our clients. If they liked it at 100, they're loving it at 50 or 25. And that's just reflected in the growth of shares outstanding as the prices come in. So I think a lot of investors believe in the long-term fundamentals there. And, again, you can't argue with a government kind of eating their own cooking, or, anyone eating their own cooking and putting their money where their mouth is.
And what's it look like in terms of, it's basically tied with the U.S. for largest economy.
Yeah.
But I got to imagine it's like as a percent of global portportlios, what, less than 10, less than 5? What is it?
Yeah. It's well under 5. And it's certainly there's a huge imbalance there, right? So you have number 1 versus number 2, and you have a couple of things in play there. Certainly, a lot of growth in the last 20 years coming out of China, getting it to that position and rivaling the U.S. in terms of largest economy. But you also have this this element of like Yankees and Red Sox, right? You need this. You have this like negative rhetoric going on between the two. You have obviously a lot going on in politics and a lot of rhetoric out of political candidates. And on the one hand, you have a rival. You're always going to have that in 1 versus 2. But on the other hand, you can't really have one without the other. And they both, through that competition, encourage tremendous growth and innovation. So I think it's really natural and healthy that rhetoric is part of it, but it's also, leads to healthy competition and tremendous growth.
I love that. I can be right. I can love the Red Sox bullpen. They just signed all these new hitters. If I'm a Yankees fan, I'm not buying the jersey. I don't care how good the team is.
Yeah, and look, you're going to be hard pressed to get a Yankees fan to pay a compliment to anything the Red Sox are doing, right? But at the end of the day, those are the games that everybody wants to go to, and those are the games that bring out the best in each team and the players. So I think there's a strong parallel between, 1 and 2 in any sport, 1 and 2 in terms of the largest economies in the world.
And just so we're clear here, the Yankees are the U.S. and the Red Sox are China, just so we can
I'll leave
upset
that
all
up
of our Boston people listeners.
depending on where you live. I have friends and family in New England who certainly would take exception to anyone saying that the Red Sox are not the U.S. in that analogy.
Right.
But
It seems like John Henry's kind of given up on them anyway, so we'll let them be. We'll save that for another pod. I cut us off on the pillars. So pillar one, or what do you call them? Pillars, or what?
yeah, we think of them as kind of pillars of our offering. So pillar 1 is China. Pillar 2 is climate, specifically carbon. So carbon cap and trade we launched a little over 3 years ago now. The first carbon cap and trade ETF, which is KRBN, that holds the 4 largest carbon emissions markets in the world. There's a European market, which is well established. It's more than 20 years old and covers all of the a majority of the emissions that are produced in Europe. There's a California market, a CCA market, that's the largest in the US. UK, after Brexit, has its own market, which is the second largest UK emissions. And then there's something called RGGI, which represents the east coast of the US, the regional greenhouse gas initiative. So those are the 4 largest markets in the world. And again, their long-term goal is to reduce carbon emissions by putting a price on those emissions and having a cap on the emissions licenses. So it's really a market-based mechanism for reducing carbon emissions over time. And it's something that we're also seeing in other regions of the world. China launched a similar program recently. There's programs in New Zealand, Korea, other regions of the world. So it's been a space that's grown rapidly over the last few years and has seen a lot of interest, both from people who are more environmentally focused and climate focused, but also people who understand the kind of economic value of a market that is structurally designed to have prices go up over time with decreasing supply and steady or increasing demand from required participants. So it's been a really interesting space that's grown a lot. And again, similar to what we do with China and providing information, it is a market that it's a little harder to access information. It's not necessarily something where it's front page news what's going on in the California carbon emissions market.
Right.
So we have Luke Oliver, our head of climate investing, writes a weekly piece, Climate Markets Now, to kind of keep our clients up to date on recent developments in those markets.
And how do you explain to the everyday investor how that works? It's sort of confusing, right? So you're essentially just buying the carbon credit futures, is it?
Correct. Yeah, it's a futures-based exposure, and it basically provides that access and that exposure in a way that's really liquid. So again, it's a 40 Act fund, it's an ETF, so we have to have daily liquidity, daily transparency. We hold the December futures for all of our funds in the carbon space, and those are the largest open interest, most liquid futures, and that's really a space that I think again is grown in popularity over the last few years for investors.
I think it's hard for the everyday investor to understand that trades like any other market.
Yep.
Right. So
Yep,
every year,
exactly.
I'll throw out random numbers, but every year the credit starts at $10,000, say, right? And I'm some company in California, I have to buy that in order to do emissions. And then next year, that's going to be 15,000 or whatever that math is.
Correct.
And so every year that you have to spend more, it's like rent. It's like environmental rent, basically, right?
So that's one way to think about it. And it's priced per ton of emissions. And this is a really interesting thing about carbon markets is depending on where you are in the world and which emissions program you're part of, they price carbon at different levels based on the maturity of the program and kind of the levels of emissions. So, you do have different pricing in different markets. California is pricing carbon in the low 30s per ton at this point, topped out just around 40. European carbon, on the other hand, topped out around 100 euros a ton. Again, it's a more mature program. So depending on where you are in the world and what level of maturity you're at in terms of your cap and trade program, you may have different prices per ton, but it allows, a tangible price for emissions. And it also allows not just an investment vehicle, but it helps companies think about and plan for the cost of emitting carbon. And as that cost goes up, maybe it makes sense for companies to invest more in technologies that will reduce carbon. Maybe a power plant switches from burning coal to burning natural gas. At some point, there are these kind of tipping points that at a certain price per ton of carbon emissions encourages industries or companies to invest in lower emissions kind of technologies.
And as an investor, do I get to, if I'm buying carbon credits, do I get to feel good about I'm saving the economy? Is there any of that piece to it, or is it just this is another different way for you to make money?
Well, it's both, right? We certainly have investors who care more about the economic impact. They care about the investment case.
Yeah.
Right. It's one of the few markets I've ever seen that's structurally designed to go up in price over time, even though there are short-term price fluctuations. The long-term goal of cap and trade is to have decreasing supply and increase that price. But we certainly have a lot of investors who care deeply about the environmental impact. And from that perspective, it's a really compelling asset class and a really compelling investment. And obviously, you'd expect to see a little bit of both, where that's one individual is making an investment decision and cares deeply about both. But in other cases, we've been on calls, particularly with institutional clients, where there's investment committee and there's somebody who's deeply passionate about reducing carbon, and there's somebody on the other side of the table who's deeply passionate about maximizing returns. And it's one of the few investments that allows for it resonates with both of those people.
Yeah, it seems like it could get caught up in excuse me, in politics, and I'm not touching that woke thing and all this stuff, but we won't get into that. It stands alone as an investment product is the bottom line.
It stands alone as an investment product, and from that perspective, it's interesting because a lot of the interest we've had in the product is from that kind of more fossil fuel type of crowd, where they're looking for a hedge to what they're doing. Exactly. So it's a great investment vehicle from that perspective as well.
And then the risk there, as I've always thought of it, is right, there's some sort of COVID or something, and they pause the increase or they cut back the increase to generate more economy growth, right? So it's regulatory risk is the main thing you're trading off there.
Yeah, people watch the regulators closely. Obviously, there's a strong correlation between economic activity and carbon emissions, right? During COVID, when people weren't, out and about, I think it was well documented how the environment recovered. It was air quality, water quality, far fewer emissions, but also, again, you have less demand for this stuff. So the price of emissions is going to drop in an environment like that. But then it also drives home how important it is to keep emissions low, the validity of these programs. So it's a double-edged sword. But certainly, you need the government to stay the course in terms of what they've laid out and what they've committed to do in these programs. And as long as that happens and they're sticking to the plan that they've laid out, we're going to see long-term growth price of carbon emissions.
In my world, we've seen it added to a lot more managed futures portfolios, trend following portfolios, right? And they're just like, I don't really care what it's doing. It's just another price, right, that we can track and see trend and do different things and trade on. So that's been interesting.
Yeah, for sure.
Which leads into pillar 3.
That's right. And that's kind of what we think of
33. How many are there again?
Total of 3.
Okay, good. Sorry, listener. I was worried there for a minute.
This is the final pillar for us here today. And that's, that's really what we think of as more of an alts type of pillar. So it encompasses real assets, as you just mentioned. We're partnered with Malec Management on KMLM, which is a real assets fund based on the strategies that they've had in place for many years. So they manage that fund. We also have, IVOL, which is interest rate volatility hedging. And that's run by Quadratic Capital and Nancy Davis, who I know you mentioned you've had on the podcast here before.
Yeah, we'll throw a link to that pod in the show notes. That was a fun one.
Fantastic. And then we also have a suite of products that are options overlay. So we launched a product called Clip that writes covered calls on KWEB. One thing you get with China Tech is a lot of volatility. Anyone who's been in those markets or been in those investments has experienced that. So we figured out why not monetize that volatility and produce some income. So writing at the money calls 30 days out. So the fund just holds KWEB and writes calls, and we pay whatever premiums we earn out to our investors. And that fund is averaged about 4% per month in terms of distributions to investors.
That's allowed. You can write calls on your own ETF.
Yep.
Nice.
Absolutely. Yeah. So it's been a great way to use the liquid options market that we see in KWEB and the volatility profile to generate income for investors. So that product's been in the market for about 2.5 years, and it's seen a lot of interest. We also have some strategies that provide downside protection along with some upside capture over time, kind of structured note sort of outcomes, KBuff and KPro, that offer either full protection and some upside capture over 2 years. So that's the full protection product is KPro, and that has about 24% of upside capture. So if KWEB goes up 24% or more over the next 2 years, we'd see that from KPro. And then KBuff is a 90% protection. So you have 10% downside. You have about 42% upside over the next 2 years. So we're trying to, use the options profile on KWEB to offer different solutions to clients who have expressed an interest in a protected version of KWEB. Again, they love the story. The volatility is hard to stomach, and they say, look, if you can provide me some protection on the downside, I'd be happy to capture some of the upside. So that's some of the stuff that we've done more recently. Yeah.
I was going to ask did you see other traders kind of putting these option structures around KWEB and say, oh, we should offer that ourselves? Or was the client saying, I want this?
So it's a little bit of both. I mean, it's the long story of ETFs, which really hasn't changed since inception, since the original ETF came out in the US in 1993, is providing access to these kind of asset classes that are traditionally harder to access, and these exposures that you can now get in one trade with an ETF that used to take several different legs of a trade. And we've seen cases with some of these options wrappers and some of these other products that we're now putting in an ETF where individuals were doing it on their own. Even with ETF models, people say, well, love the model, but don't really want to be responsible for trading and rebalancing to the model.
Yeah.
And we'll launch an ETF that actually tracks the model and provides that investment in one ticker, in one trade. So it really simplifies that access.
And you guys got some great names. KRBN, Clip. How does that whole process work out? I think we've asked Meb Faber's been on here before and was telling me that is kind of the fun part of it, right?
It is. I mean, there are a lot of, if you're in the ETF business, there are a lot of things, and tickers are always fun to figure out. What's going to represent the product with. You get 4 letters, so you have to figure out the right way to kind of have that ticker represent the product. Also something that's going to be commercially viable and memorable. And that's always a fun part of the process. And we take a poll internally, and there's a lot of strong opinions about tickers on different products.
And who SEC approves that? I heard you can't have a bad word. Like,
so,
what? That'd be more fun. That'd even be more fun.
I think it depends on it depends on your view and how you want to be represented. But yeah, they're at the exchange level. So when you list with an exchange, you tell them what tickers you'd like to have. They tell you what's available, and the exchanges can reserve the tickers for you when they're available. Yeah.
But it's not like back in the old days of buying up all the URLs and sitting on them forever. Like if you don't use it, I think it comes back available, right?
That's right. Yeah, you can't reserve a ticker indefinitely. But yeah, it's definitely, you'd be surprised. It's pretty rare that we bump up against a ticker that's not available. And if we do, we usually have a, strong support for the second or third choice. We have good outcomes there.
Circling back on the alts a little bit, what are you seeing in terms of investor interest? Is that one of your growing areas? Are they right? I know managed futures had a great 2022.
That's right.
And
Yeah.
then it's been a little bumpy since. So, a lot of managed futures people I talk to like, oh, well, it's just like 08, 09 again. I'm taking a break. Yeah, talk about that space for a minute if you can.
Yeah, no, that space has grown quite a bit. Like you say, the last few years have been strong, and there's certainly a long-term investment case, no matter where you are in the market cycle, and how you think about timing markets. A lot of interest in managed futures, a lot of interest in the covered call strategy producing income. And we've seen that space grow tremendously across all ETFs. The growth in options overlay ETFs has been amazing. There's about 50 billion in AUM now tracking those sorts of strategies.
From
So it's
zero, or from what?
Call it 3 years ago, it was close to zero, certainly, sub a billion. And that's been a hugely popular space.
And do you feel like anyone's just throwing anything that's doing similar to that out there? Or is it like you guys had a nice way to do it where it was different and selling them on your own product versus everyone else? Seems like a very competitive market.
I mean, it always is. You have to come up with an idea, not just that is creative, but also, viable from an investment perspective. So I think, you always hear this adage about ETFs that people just throw things out there and see what sticks. And I think, while that certainly, has been the case, it's also a situation where hindsight is 2020.
Yeah.
We talk to a lot of investors, a lot of managers that have phenomenal ideas that maybe the timing isn't right, or for one reason or another, it just doesn't resonate at the time. Doesn't mean it wasn't a great idea. It doesn't mean there wasn't a great investment case for it, but it is hard to stand out in this space. So I think it's, the heavy lift is launching the fund, but then there's a heavier lift in terms of getting the word out and getting investors, to make that investment.
Where we'll probably see a couple firms launch some short yen carry trade ETFs and over the next couple months.
That would be that would be timely, or at least popular.
So expand on that a little if you could, of like what's from your time in the ETF space and what the firm itself is seeing. Is there too much product chasing too few assets? Is there an unlimited new flow of assets that are looking for new product? What's your views there?
I think there's a balance, right, between a lot of assets that are invested in ETFs that track more traditional indices. And again, you get that low cost and liquidity, transparency. It's really a phenomenal vehicle, but you also have a lot of innovation. And the ETF rule that came into effect a few years ago really helped usher that along. But you also have, a lot of new asset classes coming into the wrapper. We talked about carbon, which was really hard to access for investors before, the ETF came to market a couple of years ago. And you talk about these options overlay strategies, these kind of, defined outcome type of strategies. Unless you were a wealthy, sophisticated investor, even, 5 years ago, wasn't really possible to access those strategies. So now they're coming to market, and then the market speaks. There are products that, again, we'll see a lot of success and inflows, and the ones that don't, those issuers will go back to the drawing board and figure out, where there's a viable appetite for investment. But it's always an innovation. I think back historically, you have, again, I talk about early to mid 2000s with fixed income ETFs. ETF started as equity products that held equities. And I remember, even at Goldman, the equity trading floor that traded ETFs was in an entirely different building than the fixed income trading floor. And a lot of the meetings that we were having when I left that seat and joined an issuer a few years later, we were introducing the equity traders, the ETF desk, to the fixed income traders for the first time. And there's a lot of operational work that had to be done in terms of creating the piping and connectivity between those two desks to trade bonds within the equity ETF wrapper and think about how do we price this? How does the create redeem process work? How do we settle these trades? And how does it all work? And that infrastructure and wiring took years for people to build out efficiently and understand efficiently. And as we see new asset classes come into the ETF wrapper, we're seeing that work being done over and over again. And there's a lot of innovation that goes into that as well that is kind of behind the scenes that people don't see when they're buying the ETF on screen or putting it in their portfolio.
Yeah, I know from our seat, we helped a few half a dozen firms get really up to speed very quickly on accessing the different futures markets and doing things that weren't exactly in their wheelhouse in the ETF structure. Want to circle back, you mentioned kind of stuffing the bonds in there, right? The COVID crash that was, are we finally seeing cracks in the ETF model? I can't remember which ETF, right? But its NAV was way below what the bonds were trading at or vice versa. And it was kind of that duration mismatch of like, well, we can't trade the bonds in real time like the ETF is trading. So some were arguing that's means the ETF model's broken. Some are arguing like, no, that's how it's supposed to work. You could get, if you wanted to, this was the real-time pricing, even though it was disconnected from the portfolio value. If the portfolio could have sold there, it would have been this much lower. So I don't know if there was a question there, but if you could comment on that.
Yeah, no, it's an important topic and certainly makes a lot of sense. And what you get with an ETF, because it does trade, it trades all day, every day when markets are open, and you have full transparency. It really is that price discovery vehicle. So you may have underlying assets that don't trade as much. Doesn't mean they can't trade as much. Doesn't mean you couldn't access it if you needed to. But you do get that kind of immediate feedback in terms of pricing, risk management, and hedging. And the prices that you see for ETF shares are reliant on where the underlying basket should be trading or what it's worth, where you can hedge that exposure if you're making that market, if you're making that price to the market. So you have this constant feedback loop of trades in the ETF shares, market makers and trading desks thinking about hedging that exposure and where can they put that hedge on and what's it worth and how can they put that risk on, work out of that risk efficiently, and then having that all go through the ETF create redeem process to actually source the inventory necessary to fill those orders that people are trading on when they're buying and selling shares. So it's a really efficient mechanism for price discovery. And I think it is useful. I think in the fixed income space, we've certainly seen a lot of innovation. You might have CUSIPs that don't trade, at all on a given day, or maybe for weeks, at a time, but they're in a basket, they're in an ETF that's providing price discovery every day.
Right. It's almost like you get futures, for lack of a better word, on these individual bonds that are part of this ETF, and you can trade the ETF on.
Yep. And that exists for all underlying markets. I mean, the seat that I sit in, we're providing exposure to, China Tech. When those markets are closed, we're open. We see, a lot of kind of, transfer of risk, a lot of exposure, trading hands on China Tech at a time when, the local markets are closed, and there's an efficient mechanism that allows all of that to happen.
How hard is it to get the market makers on board, right? They have to really understand what you're doing and, like you said, be able to create a hedge model that they can put their neck out there a little bit.
So market makers, there's a balance. I mean, it's a business for them. There's a cost of capital. There's a cost of hedging. They provide a huge service to the market in terms of providing that liquidity and pricing, but they're also taking a lot of risk, and there's a huge cost. There's a lot of technology. They hire a lot of smart, hardworking people to figure out those nuances. So I think it's really interesting to think about how they view the world. And in a lot of cases, they're not necessarily looking at exactly what the fund is holding. And that's a great place to start and a key piece. But they're also looking at the risk they're taking on, how they're going to hedge that risk, the correlations that they're looking at. So they have a really interesting multifaceted way of thinking about pricing, managing this risk and trading that allows for a real robustness in ETF markets that goes beyond, the ETF share represents an index. and there's that one-to-one relationship. There are, other elements that they can bake into thinking about that allows them to be really nimble and efficient in terms of providing pricing.
And then if they don't totally understand, or if it's kind of a dirty hedge, you'll just see the spread be wider. Is that how they
Correct.
fix that?
Yeah, you'll see that reflected in the risk they're taking on and the level of kind of pricing uncertainty they have. And you'll see that for the domestic equity markets, exactly where every underlying share of stock is trading, that goes into that index, that goes into that ETF. So it's really clean. And if there's trading activity, you're going to see a really tight bid-ask spread in those products because there's not a lot of uncertainty. There's not a lot of risk. And it's risk that you can hedge pretty quickly and directly. When you get into other asset classes, whether it's international markets or fixed income or some other asset class where you don't have that ability to immediately have price discovery in the underlying and hedge the underlying, they have to, they're taking a little more risk, and they're pricing that in, and you're going to see that reflected in bid-ask spreads. Might be a little wider.
Which leads me to, so if it's a new product, they might not just say no. They'll say, okay, but here's what we're going to spread it at.
Yeah, and there's a conversation that goes on there, between the issuer and the market maker, and the issuer has a decision to make about, whether that's going to be a viable product at those pricing levels. And the market maker is going to be honest about, what they can offer and where they're going to price risk. And in some cases, you see a product that gains traction quickly and is popular, and you have a lot of market makers competing for that flow, and you see bid-ask spreads tighten very quickly. And in a lot of other cases, you're going to see, a longer, more drawn-out process for that product to take on some assets and gain some traction. And then you get that competition coming in and tightening spreads.
And what, along those lines, what's it look like? I'm a new guy. I've got an idea. It'd be an awesome ETF. I've got $25 million. Is that a pipe dream? Is that doable? Like what's the cost to start up and run an ETF successfully?
Yeah, it depends on how you want to do it. Now there are a lot of firms that will provide access. They'll provide all the infrastructure because it's not just having an investment thesis and bringing that to market. There's a lot of infrastructure around it. There's, a lot of compliance that's required. Marketing and sales effort is of key importance to help clients understand what your fund is and what the investment case is. So there's a lot to it. So we see a lot of managers who come to us with ideas and they want to partner with us to launch a fund, and we're always interested in having those conversations. In other cases, clients will have an idea they'd love to see an exposure, particularly if it's an institutional client that does have an investment they can make in that strategy. We're happy to work with them and figure out the right way to get that product to market. And then you have the benefit of a publicly traded fund. So you might have that client who comes in with that initial investment, but now that investment's available to the broader, the broader investing public, and you can really get, some assets, and strike a chord with investors that leads to, a really successful ETF.
But help me understand, if I'm like, give me a bogey of like, unless you have X in assets, you really probably shouldn't do it yourself. You're going to go broke trying.
Well, it depends on the strategy, but I'd say, broadly, you're going to hear that a break-even point for an ETF is somewhere in the 50 to 100 million AUM level. Once you have an ETF up to 100 million AUM, it's going to be, an economically viable fund because there's a lot of kind of fixed cost that goes into, offering an ETF and managing the underlying, again, all that infrastructure I talked about. So that's generally the case. And what you'll see with a lot of the successful ETF issuers is they have a core group of kind of flagship funds that have sufficient AUM to, support some newer funds that are coming to market.
So you mentioned the new ETF rule that essentially took off some of the restrictions on alternatives, leverage. Like, could you summarize that rule? I don't know if that's possible, or just kind of how you guys view it.
Yeah, and what it really did was it leveled the playing field among issuers, right? So over time,
some people had no action letters, and they were out to do some things, others didn't.
Exactly. So it really standardized all of those what had previously been exemptions or not, and standardized the rule set around ETFs and bring ETFs to market, and it allowed a lot of clarity basically for issuers who may see something in the market that works a certain way based on exemptions that existed at the time they came to market, and those are no longer available, and now you have a much more kind of transparent level playing field.
So is everyone mostly happy with it? Or I guess some of the incumbents who had those no action letters maybe are mad at the competition?
I wouldn't say that. I think, it's really a nice thing about the ETF industry that still exists, and I hope continues to exist for quite some time, is there's this sense of a rising tide lifting all ships. There's plenty of, of pie for everyone to get a slice, and newcomers are welcomed, innovation is welcomed, and I think that's partly because a lot of the incumbents already have such a well-established, powerful position. So they're not necessarily gonna view the world in a way that is so defensive and ring fenced, say, oh, these new entrants are really going to threaten our business. I think there's really still this sense of openness and excitement about innovation and newcomers to the market.
But it definitely seems like a winner take all business, right? Where it's 80% of the assets are with two firms. What is the number?
Yeah. I think the top three have something like more than 80% of the assets. They've been in this game for a long time, and they have all the low hanging fruit, right? All the domestic equity funds, all the big fixed income indices. So they have a huge head start and a huge advantage, and it's deserved because they were first to market. They were the innovators. So to look back now 25 years and say, oh, I should be at the same level as somebody who has 25 years of experience and incumbency in this market is that's a tough argument to make. But there's still plenty of opportunity for newcomers. If you have a good idea, if you have the right partners in terms of marketing and distribution, and you're bringing something to market that adds value to investors, there's certainly a path to success there. And it's not a path, you're not seeing those big three incumbent issuers doing a lot of the things or trying to compete in a lot of the areas where the newcomers are in the market. So again, there's plenty of room for everyone. But having said that, you're right. If somebody wants to launch an S&P 500 ETF or a sector ETF, like, you're going up against such huge, well-established competition, and there's no value to the market because there's no innovation there. So you need to figure out what you can bring to the market that's going to be innovative.
So we'll close on that. And what do you guys see as a firm, or you personally, of like basically what's next for KraneShares? What's next for the ETF space? Where does some of that innovation come from?
Yeah, well, certainly in the options overlay space, the derivative space, there's a lot more to do there, and a lot more that I think will resonate with clients. The carbon markets continue to grow, which I think will be exciting for investors going forward. And then just more use of derivatives. You have this whole complex, the options market, which I do a lot with the options market and communicating. There's so much that can happen there that I think will be a game changer for ETF investors going forward. So a lot of opportunity.
You have any worries that is getting a little like the tail's wagging the dog, like the overlays and so much option activity that it's causing events like the beginning of the week or whenever that was last week?
Yeah, it's still efficient, right? And it's a way for investors to express a view. And just because they're not necessarily expressing it by buying the actual stock, maybe they're buying an ETF, maybe they're buying a structured product, maybe they're buying, an option or getting some other derivative exposure. It's all, investors are going to express their opinion on the markets in the most efficient way they can. So I don't believe that there's something artificial impacting something real. I think it's all real. And understanding all those dynamics can be challenging, but at the end of the day, those are investors expressing views through the most efficient vehicle. So, there's a place for it.
Yeah. My argument would be if all the investors want 2% a month and the answer is sell all these naked options, right? They're getting their view, but it's long-term dangerous or net zero for them, which they might not understand up front.
Yeah, but they need to understand that the risk and reward, as all investors do. And I think that's super important and will always be an emphasis
Yeah,
for
but it seems like
markets.
these overlay products have somewhat doing that. Yes, you're short volatility, but it's against the underlying, and
And there's
a worst case scenario isn't that bad.
yeah, and there's a lot of education, a lot of disclosure and education. And I think most ETF issuers want to ensure that their investors have a good experience, that they get the outcome that they're expecting. It doesn't do an ETF issuer any good
Yeah.
to sell their clients or investors something that ends up having a drastically different outcome. So there's certainly an alignment there. That education is important, but also making sure that clients are getting high quality investment products that deliver the outcomes that they expect is important.
Love it. Any last thoughts?
I'm just excited to see, I think, it's going to be an exciting and volatile next kind of 6 months to a year. There's strong forces in markets that are really going to be interesting to see how things shape up in the future. So I'm just really excited to see what happens.
Sounds like you're on this was not just a blip, that this may have been the start of something real.
I think it's the start of something real, and I don't think it's necessarily negative. I think it's there's always a path to success in markets, and that's what makes it fun and exciting is solving that puzzle and figuring that out.
Awesome. I love it. Well, thanks, James. It's been fun. Tell everyone where they can, you mentioned a few of these newsletters and whatnot. They just go to the website and find those.
That's right. Yeah, our website is KraneShares.com. All the information is right there. And the China Last Night newsletter, it's ChinaLastNight.com. So yeah, happy to have any of your listeners come to the website and explore, and certainly reach out with any questions.
Will do. Thanks for coming on. We'll look you up next time we're in New York.
Thanks very much, Jeff. Really appreciate it.
James. Thanks, buddy.
Bye-bye.
Okay, that's the show. Thanks to Jeff Berger for producing. Thanks to RCM for sponsoring. Thanks to James for coming on. And we'll see you next week. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.